boiling bag and hamburger helper that hadn't been out that many years ago. And that was my roommate's first year at UK. That's about the only thing we could agree on. We could never agree on. There's always one person out of three that didn't like something. We did that for a semester. Then I figured out it was $1.67 a meal if you bought 2 meals a day for 5 days, Monday through Friday. You could go anywhere on campus. There were cafeterias, and we lived about 2 blocks from one. I could walk 2 blocks and have a decent meal. Best thing was it was on the north side. It must have been a bunch of Yankees staying up there because all the food and stuff they made. It was, the ladies, elderly women who knew how to cook, but they cooked Southern. And, I'll never forget one of the first times we went over there, me and my buddies went over there, and I walked up there and I said, "Is that a big helping of that?" And that lady looked at me and she said, "You know what that is?" I said, "Well, I'm hoping it's wilted lettuce salad." She got a big grin on her face, and that's exactly what it is. From that time on, we got whatever we wanted. We'd go in there to eat, and they'd start dishing out, and some of them would break down. They go, "No, you don't want that. We got yours back here." Oh, we ate like kings. They took care of us. So, gentlemen, let me tell you, when you get married or even before you marry, never tick the cook off. You always take care of the cook, no matter what. A little piece of advice, and your life will be so much better. It's like my wife. She said, "We like it now, it's okay." And after about 20 years of marriage, she found out I really don't like cooked carrots. She got mad. "What did you tell me?" I said, "Well, I'm pretty sure you cooking. I don't care, But, I eat them with a roast. I like them like that because they taste like the roast. But just plain cooked carrots are nasty. I'm just eating them wrong. You should have said something. Okay. Now, getting in chapter 14 a little bit, and basically what we're doing is trying to evaluate divisions here, some of the tools that we use in that area. And again, it's one of those we're going to learn, do some calculating on. This weather, you don't know where to dress, warm or cold or what. Freeze in the mornings and burn up in the afternoons. The air rating.
If you turn down the volume, it stops it.
That's true.
Yeah, we figured that out in field.
There we go. Why does it turn the volume up every day? Is it automatically preset that way?
Monday, Wednesdays, it does the same thing.
Yeah. Again, it sounds like the air raiser or something. Now, again, the idea here is when we have an investment center, business center, whatever you want to call it, divisional thing, how do we measure the job that people are doing there? Well, obviously, accounting income is going to be one thing that we use because one, we got it readily available, right? And what should we consider when we're evaluating a division? What would be some common sense things just before we start going in, well, let's evaluate divisional accounting income as a performance measure. What should we need to think and consider before we start evaluating anything? Any ideas? Some things I know we've mentioned in here in prior chapters.
That it's profitable.
Well,
That you're not putting.
Let's go back a little bit before that. Is it profitable or not profitable? Again, remember, when we got a bad division, what do we typically like to do as a company? We like to send our best management in there, don't we? And sometimes it takes more than just a couple of weeks to do it, right? It might take months, years to turn something around. So if we're evaluating them, they may be coming in at a loss, but they've done a heck of a job. But even before that, what's one of the things I said, the two things that we need to make sure that match up in any job? Same I've made several times.
Responsibility, and it's like
Responsibility and authority. When we start evaluating off the bat, we might want to find out, well, if we're going to hold them responsible for this, do they have authority to make changes in it? Because if they don't, it's a crapshoot. You might as well pick a number on the roulette wheel. Because again, if they can't manipulate things and change things, how do you hold them responsible for it? So that might be one of the things to look at before we start evaluating anything. Say, also too, can we separate the evaluation of the individual with the department? Or should we? What do you think, Jerica? Should we? Well, I love, don't it, county manager, y'all hate having to think of this crap like management marketing majors, don't you? Well, give us a number. Tell us ask us what the debits are here. We get that.
I guess it would depend.
Oh man, that's a good marketing answer. It would depend.
It would depend on what they're responsible for, if they're going to be.
Well, what did we just say a minute ago about the best management, where we want them?
At your lower performing.
Yeah, the trouble spots, right? So yeah, we better be able to separate the evaluation of the department from the individual. Because if we're going to tie that individual to that department, what incentive does that manager have to go there? If he knows he's going to a losing department with trouble, what's his incentive to go if he's going to be evaluated on the results of that department? Even if he improves it a little bit, it still may be showing losses and things. So again, where's the incentive to go? Where's the incentive to do a good job? And what may happen is, if you do that, if you don't separate it and realize that what the individual's doing separate from the results of the department, you may lose some good managers real quick. They'll go elsewhere on you. If they're good, and believe it or not, people find word leaks out on you if you're good. And other companies know, competitors know. And corporate rating is not only getting ideas and products and things, it's getting individuals. Let's get the good people here. Let's get the most talented, the ones that know what they're doing. So yeah, we better be able to distinguish between the two, right? And come up and evaluate it. And again, it's not always that easy. But again, what we talked about there, if we're sending top management into tough situations, we better realize that sometimes they're going to have problems, and the department as a whole is going to have some problems before we get things straightened out. But they may be doing just a heck of a job in from a management standpoint. So we have to be able to, whatever tools we're using to evaluate, we better be able to distinguish. And as it points out in the book there, it says that the divisional measurements are really important when the divisional's accounting correlates highly with the industry average PE ratios, what they're expecting and all that. And no matter what system we have, it can always be fine-tuned, improved. And generally, you don't want to just use one thing. All these different tools we're going to look at in this chapter, you generally just don't want to use one. Because there's going to be positives and negatives on all of them. And so we want a combination of it. And no performance measurement is actually going to align the managers and organizational interests totally together. It just ain't there. Nobody's ever come up with a system that does that. Now we want to attempt that. And again, it's like, well, you can never have perfection. Well, does that preclude it as being a goal? No, we can aim for it. and we're probably not going to get there, or if we do get there, we ain't staying there long. But, you know, we can aim to try to come up with systems that align interest of the individual with the company, division, knowing that there's always going to be divergence there sooner or later. Yeah. And the thing of it too, any evaluative tool, one of the other questions, big questions, going to say, what we're measuring, do the results of the actions taken, is it reflected in the performance of the organization? What we're evaluating, is it showing what they're doing and showing the improvement? Can we distinguish that when we're going through and judging these things? Can we pick up what's being done? And that's true, like I say, if we're doing an individual separate from the department, is to evaluate who's doing what and how well are they doing. Again, overall results of the division may be negative, but the individual may be highly positive. Now, and I'm hoping some of this, I'm hoping that wasn't really profound when you read that. That divisional income is divisional revenues minus divisional costs. Yeah, like, we're breaking ground here, Copernicus. New ground. Now, it is a useful, this divisional income is useful. Is a summary of performance by weighing equally on revenues and expenses. It is beneficial there. And, you know, you got to remember, we're still using accounting income to assess the firm's performance, and that's what investors use. But we got to remember that as we're using accounting income, how is accounting income recorded and generated? We use GAAP, right? And so we do have to realize that it is an example of the problems that we do have. Now, you know, in 14.1 it says there's an example of what divisional income statements, and again, I hope that wasn't really great ground there on page 516. And, you know, we can break in, and let's just switch over to it. This is a little bit, I think, different from the book. Yeah. You know, geographic is one way how to divide up a company in divisions, and you can do it by product line or geographic, any way you want to divide it up. Company wants to divide it up. But you know, we got as it says there, we got fitness centers, and we got three geographic areas: Western, Midwestern, and Eastern. And they show us the results there of their divisional income there from last year. Now, the thing about it is, how we use this thing, how do we go about dealing with this? Well, you know, using statements like this, what would be a big advantage here with using these statements like this? I mean, you know, firms do use it to assess divisional performance, but what's a common sense reason for using it? Nobody can give me an answer? Again, we get brass tacks. One, it's information we rarely have available, isn't it? Are we not gathering these accounts, this information anyway, for the most part? It's there, it's easy, it's handy. And also, too, most people understand it in business when we start talking about, you know, after-tax income or operating income, sales, cost of goods sold. These are terms that most people in business would really agree to and say, oh yeah, I know what you're talking about there. And so, you know, it is used a lot. And again, let's think about it. Operating income and after-tax income does reflect the actions of the manager, doesn't it? I mean, what things are emphasized and cost of goods sold and all that does have some effects, the results of the actions of the manager, right? And it is an easy way to come up with it, with what's going on. Now, what's some disadvantages using this? I guess no one I left off by the way of advantage. It does make comparison of divisions easy, right? And we'll go back to that Western, Midwestern Amendment. We can look at the divisions individually. What's some disadvantages?
It's not really detailed.
Okay. Not really detailed. It may not reflect, it goes back to what you said a minute ago. When we look at this, how do we know authority and responsibility are matching up? If we're just using is. You know, maybe the manager of the division, the division head, maybe he doesn't have authority to increase assets, decrease amount of assets. You know, if there's an inconsistency there of what's going on. Again, our management control system might not be effective if we do that. Also, too, yeah, we're comparing division to division, right? We really don't know the size of these divisions, do we? One may be twice the size of another. You know, how do we know they're effectively using the resources, the assets that they have? We really don't from this, do we? Now, the difference in size we can pull out and make some changes to. One way is to use ratios. Remember that good old 282 chapter, y'all we're not calculating all those ratios. But that is one way to do it. And just some common ones here. One is the gross margin ratio. Does anybody remember what gross margin? How we calculate gross margin?
Gross margin over sales.
Gross margin over sales. That is correct. What's gross margin? It's up there on the board. Sales minus cost of goods sold. Gross profit is another way to say it. They call it, this guy calls it gross margin. Gross profit ratio would be another name for it. You know, and gross margin ratio, to use his terminology, gross profit ratio, if you're like me growing up that way, it ignores, it just really takes into account cost of goods sold, right? It ignores all other expenses. Now, to help placate that a little bit, be a little bit more comprehensive, you can have your operating margin ratio. And again, what's the formula for that?
Your operating income over sales.
Operating income over sales. And then we can go into it, again, it does take into account all the operating costs, including cost of goods sold, but you can also go in and take what's the effect of taxes. And you take your profit margin, which is income after income tax divided by sales. And so, you know, with that in mind, let's calculate these. Let's see what we got here. Okay. Gross margin ratio. What we get for Western? And you get, how far take it? Well, let's take it 4 digits. And that's usually a good rule of thumb to follow, unless told otherwise.
0.4654.
4654, which if we put a percentage on it, we get that. What about Midwestern?
4605 or 46.05.
46.05. And Eastern?
5140.
5140. So using gross margin, we'd say Eastern is preferable, right? Outperforming the other two. Let's see if operating margin does the same thing. .4 even.
1241.
Yeah, Midwest.
20.54.
Made a reversal there, haven't we? If we were ranking them on the gross margin, we'd have Eastern first, West second, and Midwest there. But now Midwest has moved up to second, I guess. Depending on what Eastern is.
22.75.
So it's still number one.
I think that has to do with the corporate overhead.
Could be. Could be. Do your profit margin. And put there so you remember. One-seventh. What is that? 14.29. Midwest.
14.4.
And Eastern.
14.97.
14.97.
15.92.
Yeah, that's what I got. 540 divided by 3,391,060. You said it was 15.92. So again, if we're evaluating, we'd see that Eastern down the line outperformed the other two divisions. And, but Midwest ranked higher than West on the operating margin ratio and profit margin. Now, you did bring up an interesting point. Probably we'll look at this on Monday a little bit more, but what were you talking about there, sir?
On the corporate overhead.
Yeah.
Well, I don't know, we saw the a couple weeks ago where they allocated it based on sales, allocated overhead based on sales, and that punished the divisions that,
That maintained
Yeah.
or even increased.
didn't necessarily relate to.
We're actually gonna look at some examples. You're exactly right. That's gonna come back to haunt us again. You say, what do you mean? Well, what happens if any one of these three divisions, if their sales go down? And we don't know how they're allocated.
Yeah.
Their corporate overhead. But the thing of it is, if they are basing it on sales, then if sales increase or let's put it this way, one division sales decrease, well, they're actually being rewarded by having less overhead corporate overhead allocated to them. And the other divisions that are maintaining or actually increasing are in essence being punished because they got to bear more overhead. Now, we do that by saying, well, ability to bear is one of the reasons we give why we allocate it that way. But again, you got to look at one. Again, that's why I say none of these are perfect. It's for every yin there's a yang, right? Reaction. For every action there's a reaction. Well, the thing of it is, yeah, we do want to allocate overhead, remember, because we want to make sure that the divisions know that, hey, they've got to cover corporate overhead. It's part of the cost of the company. And so make them aware that corporate does exist. But on the other hand, we're punishing for achievement. We're sending the wrong signals of what we want them to do. Oh, I mean, it's like, I may have used this. It used to be Ashland Oil. They had people in Buffalo and other major cities where the divisions were, and if they did real well, they got promoted to corporate headquarters. Where was corporate headquarters? Ashland, Kentucky. So the saying in the company was, oh, great, do a good job, you got to go to Ashland. Which if you're living in a major city, and even Buffalo, some people would look down upon, but compared to Ashland, it's thriving metropolis compared to us. And so, a lot of their top divisional people did not want to go to corporate for that reason. They took jobs at other companies, or they turned down promotions because they didn't want to come there. So again, if we got a system where we're allocating overhead like that, corporate overhead, it may be that we send a signal, don't pursue and be increase sales because we're going to charge you more. We got that here. We're getting ready to have a meeting after this class about summer school, how they pay faculty members for summer school. I don't know if I should say it or not, but it doesn't make a difference. They put a minimum limit of students that they want in class before they'll let it go in the summer. And y'all know that, right? A lot of times they want 12 people. Well, it's 12 people for lower level, 10 people for upper level, and 8 for graduate. Now, the reduced number for graduate makes sense to me. Tuition rates are higher, cover your costs. And then the big thing they say is, well, we got to cover our costs in summer school. So explain to me why you need 12 in lower level and 10 in upper level, because there's no difference in tuition between a freshman, sophomore class and junior, senior class, is there? Not that I know of. So I'm going, okay, what's your rational reasoning for that? You don't get an answer back. And then, what it is, what we get paid, once they hit 12 students, we get 100% of their formula. Once I get 12 to 15 students, now I'm not saying I do this or would do that. I'm not saying that. What's my incentive to get more students in the class? To encourage them to take the class? The answer is, I don't have any. Why? Extra work for me, no extra compensation. Is that the signal that more head we really want to be sending? I say it shouldn't be. I say you better come up with a different system. But nobody listens to me because I'm just a funky old faculty member with a foot half out the door, so But again, look at where you work, incentive programs they have and all that, what actions they get you to do. Is that what they're really wanting? And I dare say right there is a classic example. They haven't thought this through. Of course, the problem you have on most universities, the people running it are not from a business background. They don't look at incentive programs. And again, okay, if we do this policy, what is going to be the reaction? And it happens with you guys. They put something in and all of a sudden, ooh, wait a minute, that's not what we thought would happen. And happens all the time. I mean, happens in politics. New York City increased the tax rate. What happened? income tax rate on the top earners.
We move away.
But people moved out. Even though they increased the tax rates, their tax revenue went down. Because what? Well, guys, at the top end of the scale, you're generally more mobile, are you not? So they move out. And that's happening with companies now. Now, do you think that all these companies that move to the South, Alabama, Georgia, Florida, and all, are moving there just because of the pretty weather? Now, that's a bonus, don't get me wrong. But almost every one of them is a right-to-work state, no, not forced unionized, and also, too, lower tax rates. And so, guess what? They're flocking down there. How do you think we got Toyota? We gave them a deal for 20 years. They didn't have to pay income tax. Was that a good deal? Well, at the time, y'all too young to remember it, but that was almost had the governor thrown out of office over it. People didn't like it. Thought that you're giving them everything for free. As it turned out, it's probably a pretty good deal. Looked at all the jobs and property tax and everything down there happened, all the payroll taxes. I'd say in the long run, I don't think anybody would say that was a bad deal for the state or for Toyota right now. So again, you got to be careful when we're doing these evaluations and things. When we put these tools in, what are we really getting? What actions do we get? Again, like I say, we looked at the disadvantages there. Again, the size, we may not be able to compare them. We also, like we said, are they making good use of the assets? We don't know. Are they using their assets efficiently? And that's a big thing, obviously. Here we're providing them with millions and millions of dollars of assets. Are they doing with them what they do? Or could they downsize and still do the same job? And like I said, we just looked at those gross margin, operating margin, profit margin. Very common. They do help evaluate divisions of different sizes. Again, it's not telling us which ones are using their assets most efficiently. Not getting that at all. Now, one way that we can come up with seeing how we do it is ROI, return on investment. Now, basically, what this formula is profit margin times asset turnover. Anybody remember what's profit margin? Anybody remember?
After-tax income over sales.
After-tax income over sales, right? Okay, does anybody remember the formula for asset turnover?
Sales over assets.
Sales over assets. That is correct. So basically, what we have here, we said that was after-tax income divided by sales. That is our profit margin. And asset turnover, we said was sales divided by our assets, right? And if we're doing divisions, it'd be divisional assets, right? And that's asset turnover. Well, ROI Now, simplification, ROI, after-tax income divided by your assets. And you can think of it as an interest rate, what you're earning with your assets. And typically with interest rates, what makes us get a warm and fuzzy, high or low? In this case, high, right? What are we earning with our assets? That'd give you more of a warm fuzzy. And that's what we're trying to do. Now, let's go back to this. We now have the same income statement, same numbers we had in here. What was profit margin? Y'all got any notes there? We got West, Midwest, Eastern, and we said profit margin was, what was it in the West?
14.29.
14.29. Again, that's that 400 divided by 2,800,000 there. What was it in Mid-East?
14.38.
In Eastern?
15.92.
Okay. Now, asset turnover. Okay. All right. Asset turnover. Well, sales divided by assets, what would it be for Western?
$1.4.
1.4. 2.8 million divided by 2 million. What's Midwest?
$1.29.
1.29 again. 2,226,000 divided by 1,720,000. Huge. And then Eastern 3,391,060 divided by 2,550,000. 1.33. Then if we do ROI, after-tax income, 400,000, divided by assets, 20%. Or 14.29 times 1.4 should be close to 0.2 also, mathematically. Midwest,
18.6.
so the West went back ahead of them. Does Eastern still hold 201 point?
21.8.
Now, the thing about it is, the reason we're calculating this looked at, capital is a scarce resource, those assets. And so, you know, how well are they using them? You know, if one division is really low and all that, not using them well, we might want to invest it somewhere else for the benefit of the stockholders, right? But to where it's going to be, get the best bang for the buck, as they say. Now, the thing about it too, though, there are, again, as are there positives here. We're looking at how well, we're taking into account the size, how are they using the assets they have. But you got to remember, ROI is very short-term focus. what have you done for me lately, so to speak. And it tends to make people focus on each individual activity, current activity, and it tends to make them myopic, that they don't see the whole picture. And, you know, the thing about it is, this is where goal congruence can really get messed up real quick. You say, what do you mean? Well, let's say that we have a project out there. And when we take the sales divided by the assets it would take to do this project, we're coming up with an ROI of 19%. And we offer to the divisions. What's going to be the reaction of the Eastern Division head? What's that Eastern Division department head going to say?
He's not gonna like it because the percentage is lower than what he's already at.
Okay. No, and does it help any when we say, well, what if the minimum incorporated return that we want to maintain, say is 17.5? Well, 19% meets that, right? But you're right. If I had a project that's paying 19% to something that's making 21.18% now, we know, I don't know what it'll end up as, because it depends on the size of that 19%, but we all know what's happened to that 21.18, going down. So he ain't gonna like it. Now the company as a whole may be better off if we did it, but the division as a whole is not going to be. And how's he gonna be evaluated? Usually on divisional numbers, right? So his first reaction will say, nah, don't want it. And you can make the same argument for the Western Division, right? Saying, no, we don't want that because that's going to lower that 20% ROI. Only one that's going to be enthusiastic about is Midwest. I mean, it's close to what they have now, but invariably 19% is more than 18.6. So it's going to have a thing to lift him up, or her up, I guess I should say, him or her. So again, if the return is 17.5 is what the company minimal acceptable, we might have suboptimal decisions being made because it's going to hurt me. It's going to hurt my division. Whereas the company as a whole would be better served if they did it. You see how you get shortcomings here? These things? Let's work one little problem just again. Because sometimes y'all, I get emails from people and it's not anything, it's just, learning to read how the author has it. I know y'all that never happens to any of y'all. But for the sake of others, right? Let's just do a simple one. Let's just do 19 and 20. It's year 1 and year 2. It's real simple. Exercise 19 and 20. This is come up with operating income for the 2 divisions. What was sales for East and West?
1,200 for east. Oh, well, I'm sorry. 14 million. Sorry, I was doing it.
Well, we can do it that way. 1,200 and 3,800. You can drop the last three, just 0.5 on some of those.
Alright.
Cost of goods sold,
769.5. 1900. 72 for the next.
gross margin was what? It's up to 0.5. 440.
Yeah.
Okay, over here 1,900. Is that correct? And then we got what? They give us other general administrative, or well, we can do it. What do they got? They got corporate overhead. Was what?
72.
And
228.
and other operating expense.
158.5. 1100.
And so operating income,
200.
is 200 even,
Yeah. 572.
and 576.
572.
572. Okay, they give us income tax?
Says ignore taxes.
Huh?
Says to ignore taxes.
Oh, okay. Ignore taxes. So, divisional income is greater where?
West.
West. Who has the greatest gross margin percentage? What do you get?
0.5.
Yeah, it's 50%, 1,900, 3,800, right? And east is what?
36.71.
What'd you say, sir?
36.71%.
Okay, and what's operating operating margin percentage?
16.67 for east. $15.05 for west.
So we can say that West has a gross margin percentage advantage. It has the total divisional income, and operating margin goes to the East. How are they applying corporate overhead? Any ideas?
Based on revenue.
How much? Yeah.
% of sales.
Looks to be 6% of sales. 6% of 1,200 is 72, and 6% of 38 is your 228. So that's how it applies. Now, if you do it for the second year, by the way, you'll find out that things get reversed. In 19, or excuse me, from 19 to 20, the East stays pretty much the same. I mean, you got what? The sales stayed the same, right? Cost of goods sold changed. What was cost of goods sold? 20 there.
I think it stayed the same too.
Yeah.
We'll read it again.
469.
0.5.
Yeah. Or, I mean, 769. Sorry.
What?
769.
769, which made this what?
440.
No, it ain't 440.
I thought it was just good.
430.
Yeah, I was gonna say. 430.5. Corporate overhead, was it still 72?
90,000.
90? And what was other operating? 158.5, which makes operating income.
$182.
82. And then over here, that changed drastically, didn't it? Well, it dropped 1,000, or a million actually, but you got like 28 and 1,400. Corporate overhead was what?
210.
To what?
210.
210. And other administrative operating expenses?
1,100.
And so that makes operating income what? 90?
Yes.
Is that right?
Yes.
Okay. So right off the bat, East went from, just comparing the bottom line operating income, they came out like a shining star in year 2. And notice that the profit margin, or the gross margin, it's still 50% in the West. What it is in the East? It didn't change that much, does it? Since we didn't change that. 430.5 divided by 1,200. What is it?
35.88.
35.88. Notice if we're just looking at gross margin ratio, we'd still say the West is better there. But now the operating income margin is going to change drastically. Again, not so much the East. What's the East go down to? 182 divided by 1,200.
15.17.
Okay. But I guarantee that puppy's changed a whole lot. 90 divided by 2,800.
3.21.
I think it's interesting that their gross margin stayed the same. Again, corporate overhead's allocated based upon relative revenues, and the East, even though the East is not, when we're evaluating the East and we're looking at operating income, their share of the corporate overhead is being affected by what happened in the West. They went from 72 to 90. Corporate allocate ahead to them, and notice the West went from 228 to 210. Exactly what we're saying. Even though the West went down, they sort of got a benefit out of it because they didn't bear as much corporate expense. Exactly what we were saying. Okay. Well,